Investing mistakes that keep people poor for life. Investing is often hailed as the key to financial freedom. Yet, despite earning decent incomes, millions of people remain trapped in a cycle of financial struggle. The issue isn't always a lack of money, it's the mistakes people make when trying to grow it. Avoiding these common investing pitfalls can be the difference between building wealth and staying financially stagnant. Here are 5 investing mistakes that can keep people poor for life, and how to avoid them. 1. Ignoring the power of compound interest. One of the most costly mistakes investors make is underestimating the power of compound interest. Compounding allows your investments to grow exponentially over time, earning interest on interest. The longer your money stays invested, the more it grows. Yet many people delay investing, thinking they'll start later, often when they have more money or after paying off debts. For example, consider 2 individuals. Alice starts investing $200 a month at age 25, while Bob starts investing the same amount at age 35. Assuming a modest 7% annual return, by age 65, Alice will have over $370,000, while Bob will have just around $150,000. That 10-year delay cost Bob more than half of what Alice earned, simply because of lost compounding time. Starting early, even with small amounts, can make a massive difference over decades. Compound interest rewards patience, consistency, and time, not sheer luck or skill. By delaying investment, you give up one of the most powerful tools for wealth creation. 2. Chasing short-term gains. Another mistake that traps people financially is the obsession with short-term gains. Many investors chase trends or hot investments, hoping to make a quick profit. From meme stocks to cryptocurrencies, the temptation to jump on a hype train is everywhere. The problem? Short-term thinking often leads to panic selling during downturns or buying at inflated prices. Markets are inherently volatile, and even the best investments can experience temporary losses. If you make decisions based on fear or excitement rather than long-term strategy, you're likely to sell low and buy high, the exact opposite of a profitable investment strategy. Successful investing requires a long-term mindset. Legendary investor Warren Buffett once said, "The stock market is designed to transfer money from the impatient to the patient." By focusing on long-term growth and ignoring short-term noise, you allow your investments to grow steadily, harnessing the full potential of the markets. 3. Failing to diversify. Don't put all your eggs in one basket is an old saying, but many investors ignore it. Concentrating your investments in a single stock, sector, or asset class can be disastrous. If that investment performs poorly, your entire portfolio suffers. Diversification spreads risk across multiple investments. This can include a mix of stocks, bonds, real estate, or commodities. Even within the stock market, diversifying across different sectors and countries can protect your wealth from unforeseen events. For instance, someone invested solely in tech stocks may suffer if that sector experiences a downturn, whereas a diversified portfolio can absorb shocks and maintain steady growth. Diversification isn't about avoiding risk entirely, it's about managing risk intelligently. Investors who fail to diversify often experience more dramatic losses, which can be difficult to recover from, keeping them trapped in financial uncertainty for years or even decades. 4. Letting emotions drive decisions. Emotional investing is a silent killer of wealth. Fear and greed can push people to make impulsive decisions that sabotage their financial goals. During a market crash, fear can prompt panic selling, locking in losses. On the other hand, greed can tempt investors to buy overvalued assets in the hope of a quick windfall. This emotional roller coaster often leads to a cycle of mistakes. Selling in panic or buying out of excitement rarely aligns with a rational investment strategy. Over time, these decisions compound, resulting in significant lost opportunities and wealth that could have been earned through disciplined investing. Successful investors maintain a clear, objective strategy. They set goals, diversify, and stick to a plan even during market turbulence. Tools such as automatic investments, portfolio rebalancing, and predetermined exit strategies can help remove emotion from the decision-making process. By keeping feelings in check, you avoid costly mistakes and ensure your money works for you over time. 5. Ignoring fees and expenses. Many investors overlook the hidden costs of investing. Mutual fund fees, trading commissions, and management expenses can quietly erode your returns. High fees are especially damaging over time because they reduce the compounding effect. For example, imagine investing $10,000 in a mutual fund that returns 8% annually but charges a 2% fee. Over 30 years, that fee reduces your ending balance from about $100,000 to roughly $65,000, a difference of $35,000. Choosing lower-cost alternatives, like index funds or ETFs, can significantly improve long-term outcomes. It's also important to understand soft costs, such as taxes on capital gains or frequent trading penalties. Being mindful of all expenses ensures that your money stays invested, grows consistently, and isn't chipped away by fees you could have avoided. Bonus mistakes to watch out for. While the 5 mistakes above are the most common, other behaviors can also hinder wealth building. These include failing to educate yourself about investing, ignoring inflation, relying solely on advice from friends or social media, and not having an emergency fund. Each of these factors may seem minor, but when combined, they can prevent you from reaching financial freedom. Small changes, big impact. Building wealth isn't about luck. It's about making smart decisions and avoiding common pitfalls. Starting early, focusing on long-term growth, diversifying your portfolio, controlling emotions, and minimizing fees are strategies that can dramatically increase your chances of financial security. Financial freedom isn't reserved for the rich. It's achieved by those who make disciplined, informed choices. Avoiding the traps that keep most people poor for life may seem simple, but it requires awareness, patience, and commitment. Every poor decision you avoid brings you one step closer to building lasting wealth, while every smart choice compounds over time, growing your financial foundation for decades to come. Investing is a strategy, not a gamble. By learning from the mistakes others make, you can navigate the financial world with confidence, steadily building a portfolio that works for you, not against you. Wealth is not built overnight, but by avoiding common pitfalls, staying consistent, and thinking long-term, you can secure your financial future and leave behind the cycle of scarcity that keeps so many trapped in financial struggle. Remember, building wealth isn't about luck. It's about avoiding common mistakes and making smart, consistent choices. Start early, stay patient, diversify, control your emotions, and watch fees closely. If you found these tips helpful, don't forget to like this video, subscribe to the channel, and hit the bell icon so you never miss future money-smart strategies. Drop a comment below and let us know which investing mistake you've struggled with the most. We'd love to hear your story. Thanks for watching, and here's to smarter investing and a brighter financial future.